and happy Friday, June 26th. Welcome to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going to the markets today, the bad news just continued on with those certain states we mentioned yesterday. Texas being one of them, Florida, California, Arizona, announcing more cases, questioning the idea of a reopening, if that's going to happen or not. Investors get worried on that. And, really the worry and the concern is that we could have a reoccurrence or a resurgence that would further lock down folks and lock down the economy. So as such, we saw the Dow, the S&P, and the NASDAQ all drop, at the 3.3, 2.9, and 1.9% range respectively. So they're all down today. We did see crude oil at the $38 barrel a range. So not huge movements there on the crude oil futures for today. We did see the U.S. 10-year Treasury yield tighten quite a bit more, 4 basis points, 0.04. So that trade was around 0.64 today at the close of business. Jumping over the multifamily rates, FHA 223F tightened by just 1 basis points in the mid-range at 244. That is 2.44 fixed for 35 years. And the 221 D4, that rate is now quoting at 3.09. That's 309, and that's fixed for 40 years. Go over to the agency desk. We are seeing Fannie widen the spreads today by 5 basis points. I'll get to that in a minute. So they're quoting now at 295. That's 2.95. Freddie Mac has not reacted yet to the rates. They don't change their rates as frequently. So still quoting the 306. We'll see where they end up at the next Freddie auction. But they are at 306 today on the 10-year money. Now, jumping over to that trade I mentioned just now as far as the precipitous fall of the 10-year U.S. Treasury and then the spreads widening. I've seen that happen on agency debt. I've also seen that happen on FHA debt. It's really not that uncommon. What that means is that traders are reacting to market news. They're seeing this precipitous fall, this kind of flight to safety, and they're hedging against that because they really don't know where the trade is at. So rather than kind of follow the 10-year down, they actually are, increasing their margin, their spread, if you will, so that they can cover what the actual market is going to be when things settle. So that is not an unusual thing. If the market does in fact settle in a lower U.S. 10-year Treasury range, that's when you do see those multifamily rates start to come down. Typically, they do move up a lot faster than they move down. And so again, that's not an uncommon reaction. I think a lot of folks are thinking about what is going to happen. I spoke with a large family office. They own thousands of units. They're low-income housing tax credit developers primarily. And they mentioned that a few of their equity sources, their LPs they use, are not bidding on new business. They are closing what's in their current pipeline, but they're not bidding on new business right now at this moment. I think that's just a reflection, again, of the uncertainty. Collections in June remain very strong, according to the national publications of these rental collections. I'm sure you're all familiar with that. A lot of folks are collecting well in the 90% range, which is good to see. I think the concern is that if another second stimulus check isn't signed into law, that is a big if, right? And if it doesn't happen, could affect rental collections with tenants not being able to make their rent payments. These are all big ifs. And frankly, Monday we could hear about vaccine news or treatment news, and all of a sudden the market's back up and everybody's feeling warm and fuzzy about the reopening of the economy. This year really truly is the COVID news market. Okay, so it's very reactive to the news. It reminds me of something I learned when I was at Graduate School of Banking here in Colorado at CU several years back, and I was the CEO of a bank simulation project. And we were getting different news every single day as the CEO. They would just create these, market news ups and downs, and you'd have contrasting articles and nothing seemed to match or make any sense. Very hard to interpret, much like real life. And it really hammered the point home of all the successful financial institutions I've worked for, and that is stick to your fundamentals. Stick to your fundamental business plan, and you'll be okay. There's a lot of ups and downs, economically speaking. There are things that impact, but largely what we see when we're looking at these financial and these market reactions are perceptual impacts. What people think is going to happen. So if you stick to your fundamentals and stick to your fundamental business plan, I've worked for banks and financial institutions around for hundreds of years that have been very successful by sticking to those fundamentals. So I'm going to end this week with that positive note. Thank you for tuning in to another edition of Rate Desk. I'm your host, Michael Thomas, signing off.